aware that both the seasonalities that I look at, the long-term one that I've shown you, just at a September sell-off based on nearly 100 years of history, peaking around September 6th. At the beginning of September. Here we are in mid-September. This seasonality based on the last 20 years of history and the seasonality from a post-election cycle suggesting a mid-September sell-off. Now, this seasonality has been wrong, but so has the longer-term seasonality points as well. We're late starting the September sell-off, and there's been other points that it hasn't been correct. It's been more correct than this seasonality based on the post-election cycle, the last 20 years. So just for what it's worth, the longer-term seasonality suggests that we see a September sell-off. Should have already started. This seasonality, which was wrong in August, which was wrong in April, say March, and that we got a March rally and we continue to fall until April. And there's been other points in history. The seasonality has not been correct. Here it was suggesting an August sell-off. We didn't really get that. We went back up and tested the highs. We did get that, but that was late, and it suggested early volatility in September, which we did not get. We did get a rising wedge from early September, no real volatility. Going into the first part of September, we bottomed at the very beginning of September, so it's not been perfect. It is suggesting a sell-off here in mid-September down to an October low. We'll see if we get back on track with this thing, but it has been wrong. Suggesting a sell-off from the July peak, which we did not get. We went much sideways and didn't get any significant correction. The seasonality not perfect. It has been right at many times, but not perfect. Suggesting a mid-September sell-off here on this cycle. We stopped following for a while. We'll see if it gets back on track now, but the S&P stopped following this. We'll see if it gets back in line, and we end up getting a sell-off into October, followed by, and I do think we will see a run-up going from an October low or possibly a September low, but the September sell-off hasn't started. It's likely going into October, and this could follow, which I think is very, very possible. Just a parabolic rise to finish the climax move, the final phase of the blow-off top. So a mid-September sell-off into an October low. We'll see if that happens. We'll probably get back on track with this seasonality after deviating from it just a little bit. 8 count on NASDAQ, a 9 count on the S&P 500. I don't know if this means anything. We got up to bar 8. Last time we got up to bar 8, we never made it to bar 9, and we had the sell-off in August. Now we've come back up. We've made new highs. We get another 8 count. Now the 9 count can complete. It does not have to be the high of the count. It'll be a perfected sell signal as long as bar 8 or 9 is the high of the count. Bar 8 is the high of the count so far. So we can get the 9 count and still have a down day with the Fed and still have a 9 count complete on the NASDAQ. 1, 2, 3, 4, as long as we don't close below this bar from 4 sessions ago, that if you sell off and you give back the rally over the last few days here and you don't close below that low, you'll complete a 9 count. Over here, it didn't play out. We ended up selling off without completing the count. We'll be watching to see what happens. Does this count complete? Do we see the 9 count? Do we try to rally and end up having the 9 bar the high of the count, but then end up reversing with the Fed? We'll be watching what happens with this count tomorrow. NASDAQ daily chart. The S&P 500 completed a 9 count reversal signal today. Today was the 9 bar. NASDAQ got up to bar 8, just suggesting a pullback or a complete reversal. Now, all the 9 counts and 13 nines have been associated with corrections. We got the 9 here, went a little bit higher back in June, and we corrected. Went up, got a 13.9 right here, and we went sideways here in July before the run-up to the July high on July 31st. Just before the July 31st high, we got a 9 count there, went a little bit higher, and we corrected. Wasn't a long correction, but we still corrected with that 9 count. Rallied up to get another 9 count here in August, and we corrected. More or less went sideways on the S&P 500 in August and early September, drifting slightly higher each time, but we went sideways. We've had this final push that has formed a rising wedge, and we slightly breached the trend line on the 15-minute chart at the end of the session, and you get another 9 count. Every single 9 count in the run-up has given us some type of corrective move. I believe we're going to get a bigger corrective move than what any of these counts were associated with. They're sideways moves or smaller pullbacks. Still think we're going to new highs after this sell-off. I told you that the April bottom started the final phase of the blow-off top. I think we'll get one more bigger pullback here, and then I think you're going to get the final climax move of that final phase of the blow-off top. I think that will produce a top in the coming months ahead here. I think by January, February, I think the Fed's going to be doing emergency cuts. I think we'll pull back, we'll rally to new highs. Stock market will start crashing back to the April lows on NASDAQ and S&P, and the Fed will panic. But just be aware, as we go into the Fed meeting, you have an 8 of a 9 on NASDAQ. You've got a 9 count here on the S&P 500 daily chart. Okay, tomorrow's a big day. The Fed announcement. We had the Dow down 125 points down, just over 1/4%. The S&P was down 8.5 points, down 0.13%. NASDAQ ended flat. NASDAQ composite down almost 15 points. Of Russell was down 0.11%, and the VIX was up by 4%. Fed fund futures, the betting market's predicting that we'll get a quarter point cut, 96% chance we get a quarter point cut, 4% chance we get half a point, and again, this cut's already priced into the market. Fed fund futures are betting on a 0.25% cut here in September, another cut in October, the end of October to the 29th, and then another cut, 3 cuts for the year by December. All of those are above 50%. Now at this point, this changes every day. I've talked about, can we get a hawkish cut out of the Fed, where the Fed starts to cut and then they either move back to the wait and see mode, and it's one and done, or they express more concerns about inflation that causes the markets to think that the Fed is going to hesitate, continue to cut. And I'm just telling you, look, the way it's happened before, 2000 bursting of the tech bubble with the financial crisis in the 2007 top, the Fed runs around and they tell us how wonderful their policies are, that we're going to get this soft landing. Okay, they always start with that fairy tale. It doesn't exist. It's fake. They want to believe that they can micromanage the economy. They can't. Their policies actually are destructive and end up causing problems in the economy. They always lead to a negative outcome. What usually happens, and in both of those cases, we had inflation ticking up. Stock market peak began to crash to kick off the bear kick off the bear market ahead of the recession, and the recession shortly followed. Then, when the market crashed, the Fed panicked. January of 2001, they started jumbo cuts. In January 2008, they started jumbo cuts. Even though inflation was rising back up, that's the way it's worked in the past. Both times they had emergency meetings. Panicked. Probably going to get a cut here. This time, the situation is a little bit different. Powell's under a lot of pressure to cut rates. He's been concerned about Trump's tariffs causing inflation. Tariffs don't cause inflation. That's another day, another argument, but they don't. Powell believes that they do. It's because there are a bunch of Keynesians over there at the Fed. They applied Keynesian economics during the Great Depression, and it extended it another 6 or 7 years. That's what Keynesian economics does. A bunch of economic stuff that is policies that do not work and end up making everything worse. If you believe Keynesian economics, then half the time you don't. That's why the Fed never saw housing bubble. That's why the Fed told us inflation was transitory. That's why the Fed never sees recession coming. It's because they believe all of this nonsense. And it is a bunch of nonsense. Again, I digress. That's for another day. But the way it usually happens is we start getting the cuts when the Fed panics after they tell us how everything is great. This time, I told you, it can be very different. Powell should be slashing rates right now. We are going into a recession. Okay, he doesn't believe we're going into recession because he believes that, we're going to have this soft landing. Now he's showing concerns in the labor market. Well, what if we start getting good reports in the labor market? Then again, What happened, I covered this a couple weeks ago. In 2007, we started getting a negative number, which we got in June, and then some positive reports followed. The market went up, made a new high, topped, began to crash, and then later in 2007, the recession began. In December, the Fed began to panic. In January, I think we could see the same kind of thing here where we go off, we rally up to new highs. Maybe we get a one and done. Maybe the Fed stops cutting. By come January, just before the January 2026 meeting, which is on January 28th at the end of January, just before that, they could do an emergency cut, or just after that. In the past, in the Januaries that they did, like in 2007, they did an emergency cut before the January meeting. And again, I think that if we see the market sell off, rebound back up, making new highs, I think by January, just before the January meeting or just after it, I think the Fed could be panicking if we go up and we make new highs. If we do, I think we're going back to test the April lows and get a bigger crash than what we saw at the beginning of the year. 21% sell-off on the S&P, the 25% sell-off on the NASDAQ. We're seeing the NASDAQ drop 30, 40% like it did with the bursting of the tech bubble. The Fed's going to panic. Powell's term is coming to a conclusion. The Fed will panic and they'll slash rates to try to artificially prop up markets. It won't work. Powell should have been cutting rates long ago. He started to cut them just before the election. Powell is a very political person. He left rates too low for too long because he wanted to get reappointed. Then he cut rates right before the election. I mean, he's very political. Talks about this independent stuff, and again, he's not independent. How he's keeping rates elevated when he should be slashing them. And he should be slashing them because all kinds of warning signs that a recession is coming. He just is blind to it, as the Fed usually is. I think we can get a hawkish cut out of the Fed. I think it could be a one and done. If we see some stronger jobs reports come in, it could put the Fed on holds, sitting on the sidelines. Market could go higher, then we get a negative jobs report, and that ends up doing it. That's what happened in 2007. You get a big negative number for the jobs report that ended up terminating the bull market. Still think you can get Jamie Dimon's crack in the bond market that could end up having problems as well. We'll see. It could be a couple of different things, but this is likely going to be a sell the news event. The rate cut's already priced in. Wow, they're going to do a quarter. Wow. The majority of people on social media, the majority of people believe we're going to get this cut and then we're really going to go. When, again, we've had this massive rally from the April 7th bottom. We rallied up, July high, started going sideways, and then drifting higher August, and now in September into the trend lines of resistance. Morgan Stanley and JP Morgan both think that we'll see a sell-off with the Fed. I think it'll be a sell the news event. I think we'll correct. Once we correct, we're going to get the final climax rally, and then I think you're going to see the markets take a tumble. I wouldn't be surprised to see a 30 or 40 plus % sell-off on the NASDAQ. That's what happened with the bursting of the tech bubble to kick off the bear market. NASDAQ tumbled 42% in about 2 months. Think it's possible? You better study history. The rate cut is already priced in. Today we closed back below the upper Bollinger Band. I told you to be watching for that. S&P has quadruple negative divergence. It's the strongest sell signal in technical analysis right before the Fed meeting. Is triple and quadruple negative divergences. We have what looks to be an ending diagonal, and in on this 15-minute chart, we have this rising wedge that we have as we have this quadruple negative divergence and multiple points of negative divergence in the 15-minute time frame and on intraday charts. Prices made new highs. The MACD is not. It's got multiple point divergences. Each of these divergences has given us volatility but have not yet produced a major reversal yet. My signals remain bullish. Let me repeat that. My signals remain bullish. They had turned bearish in July and reverted right back to bullish. A couple of them turned bearish here with the downturn in August, but reverted right back to bullish. My signals remain bullish as we form multiple point divergences here on the MACD and on the RSI. And on the stochastic here, that is now getting a bearish touch, about ready to roll over at extremes. As we're headed into the Fed meeting, we're likely going to see a hawkish cut out of the Fed. We're probably going to cut out of the Fed. What they say is what's going to matter. And if Powell still maintains a hawkish tone or still showing reservations about cutting or concerns about Trump's tariffs or inflation or whatever, again, you're likely going to get a hawkish cut. Saying something's going to happen. It looks like we have an ending diagonal. That's what it looks like. But you've got, if I zoom out here, you've got this divergence. We had a divergence over here. This looks very similar, where we went in this range, drifting slightly higher here from the December peak to the January peak to the February peak. And here you have the same thing from the July peak to the two peaks in August, mid-August, late August there, and now in September, and you've got this divergence. Again, I think we're likely going to at least pull back to the February high right here near the 100 period in the lower boundary of the cloud, or again, maybe come closer to the 200 or overthrow it. Likely going to see this sell-off, and then we're going to go get one final push higher. I think the S&P is going to try to form a head and shoulders pattern, and I think once we top out, I think you're coming back to the April low. And I think you're going to try to form a massive head and shoulders as we get a broadening formation completing on NVIDIA and the NASDAQ. Multiple point divergences here on the MACD. It's given us corrections on the way up, smaller corrections here since the July peak in the most recent price action. But again, we're likely going to get a bigger one. I believe will be wave 4, and then I think we'll get wave 5. And then in the coming months ahead, I think that will complete the bull market. Again, all over social media, the majority of people believe that the rate cuts are going to happen and it's going to be extremely bullish. And again, it's likely going to be a sell the news event. Take us back here. And again, this looks very, very similar to what we had back over here. I don't think we get this, but I think we're pulling back towards the longer term moving averages or towards the cloud here, towards the February high. And I think you're going to get a 4. The quadruple negative divergence ends up completing the wave 3. Once 4 is done, I think you'll get the 5, taking us towards major trend lines in the weekly time frame. And then I think you're going to collapse all the way back down to the April low. And I think you've got a possible massive head and shoulders setting up here as a broadening formation is forming on the NASDAQ and NVIDIA. Wave of speculation. Remember, my signals remain bullish. As we remain overbought, as they flipped back to bullish, you're forming this massive quadruple negative divergence. I think we're going to buy the dip event with a sell the news after a sell the news event. And I think that up here, when we get up here to complete the top, nobody's going to think it's a top. Buy the dip, buy the dip. It can remain overbought near tops as we've seen here, as we've seen back over here. You're likely going to get the same thing where we go up and we get this period of being overbought, but it's going to be followed by a crash back down to the April low. Eventually, we're going to take out that low. And again, you're probably going to see a bigger drop in the next crash to kick off the bear market that's going to be bigger than this 21% sell-off right here, bigger than the 25, 26% sell-off that we saw with the NASDAQ. We saw these divergences. We went higher today and, again, got another reference point of it, but we here in the 5-minute time frame. But, again, we got to take out this 200. If we're going to go lower, we gapped higher, and then we sold off to the 200, and we just kind of went sideways. So, again, if we're going to sell off, you got to take out the 200. If you're going to bounce and try to go back and test the highs, you got to hold above that 200 period moving average here in the 5-minute time frame. By the close, we had a slight breach of the trend line, the rising trend line right here in our 15-minute time frame. This is the rising wedge we've had since early September here. We rose back up. They're starting to sell off in late August. On August 28th, we bottomed out at the beginning of September here, and we formed this rising wedge, which is now breaching. In order to sell off, you got to take out the trend line, and the 50, which we're doing. You got to take out the 50, which we're doing. The 50 period has been acting as support. You got above it here, acted as support. Here we just came back to it to get the bullish cross of the 50, the 200, acted as support. Here the 50 acted as support. Here the 50 acted as support in the trend line. Here the 50 acted as support. Here the 50 acted as support. after we gapped higher today and we slammed into this trend line, and then now we're breaking the 50 at the moment, and we're breaking the trend line. If you take out the cloud, then again, you can start selling off surrounding the Fed. You've got this multiple point negative divergence here on the MACD and the RSI. Gapped higher today. We got a black candlestick going into this upper boundary right here, and you've got the trend line at the very end of the session breaking. The sell-off continues ahead of the Fed announcement. Again, breaking down from the rising wedge, you're breaking these support levels. And if we take out the cloud, you take out the 50, you take out the trend line, then you can begin to move in the other direction. You can begin to turn down. So we'll be watching. Do we get today's high holding, which is right at a trend line, the daily time frame? We now breaking the trend line here, breaking the 50 period here. Do we now take out the cloud and start moving back to the 200 and maybe even attempting to take that out? But again, it's likely that this Fed announcement is going to be a sell the news event. So it's possible that that was the peak today, slamming up into this trend line, this rising wedge trend line, which is a reversal pattern, which also completed another reference point of a divergence here on the 60-minute chart. And here's a little rising wedge, slightly breaching it there on the 15-minute chart, a little bit harder to see here on the 60-minute chart. But if we're going to sell off, we got to take out the 50 here, the green line, you got to take out the 200 period, and then you got to take out those levels that stay below them on the daily chart. On the daily chart, we've got to come down here and take out the 10 period and the 20 period and the momentum cloud, break this other trend line, which slightly moved on me from that hammer low. Getting rejection off the upper Bollinger Band and getting rejection off of this trend line right here, slightly above this bar right here. I've connected the peak right here and the peak right here, and that's just slightly above that here. If we include the very top of this, it's just a little bit lower, which we've already slammed into it. So again, I'm just redrawing it from that peak there. But clearly we have a quadruple negative diversion. Divergence is in the intraday time frame. Now a close below our upper band. Bollinger Band here in the daily time frame. The stochastic here ready to roll over, also forming multiple point diversions. NASDAQ also getting a close below the upper Bollinger Band. We'll be watching, do we start moving back to the 10 and 20 period moving averages? Do we start moving back to the 50? And if we do, negative divergences play out on the MACD and the RSI, then the NASDAQ is likely headed back again to the February high right here, the lower end of the cloud here in this area, or maybe the 200 if it might be closer to this level by then, by the time we reach it. But again, you're likely headed back towards this level of support or towards the 200 period, and you'll probably take out the 50 period if we break the trend line from our last minor low. Same thing with the NASDAQ. The divergence over here, right here, initially gave us some volatility, ended up forming a larger divergence and moving just above that area, and that's what we've done here. I don't think the NASDAQ has topped. I think we'll sell off, and I think we will go higher, but you got a good shot that this divergence is going to play out surrounding the Fed. We have a triple negative divergence on NASDAQ. S&P has a quadruple negative divergence, and those are the two strongest sell signals in technical analysis before the Fed meeting. They're in place on the charts ahead of the Fed meeting. NASDAQ was down almost 20 points today, moved up to a new high and gave it back. NASDAQ's got a massive broadening formation, so does NVIDIA. Again, NVIDIA has already peaked. NASDAQ moved to a new high. They're diverging. This is what they did back over here at the July peak right here in 2024. Again, you'll probably move back to the February high and then go on and go up and hit this trend line eventually. If we don't do it immediately and you reverse down with the diversions, or if we keep going, you slam into it, you turn down, and then you go back up and you hit it again, one or the other, I think it's very likely you're going to see a sell the news event with the Fed. The divergences all over the place on the intraday charts and the daily chart.